Monaco 64, home of alternative economics and contrarian views. I'm talking with Eric Yeung again today, aka King Kong 9888 on X. He's very active there. Welcome back, Eric. How are you?
I'm doing good, Mario. Thank you for having me on your show again.
Great. I think the last time we spoke, things weren't as busy as they're now. I mean, there's so much going on, especially gold and silver, government bonds, geopolitics. But I want to start with this here. Uh, I think I retweeted this to you, and it's from
Yes.
a former bullion dealer. I think at Bear Stearns and then JP Morgan, Rob Gottlieb. He's quite active on X. He said, "Welcome back to major dislocations in precious metals." I'll let you because you've read that and you're quite familiar with the EFP and also the tariffs on the Swiss bars that Trump said that they are not applicable to gold 100 ounce and kilo bars. But some people are noting that they haven't actually put out the executive order. And this guy, Rob Gottlieb, is saying that gold and silver are going up because of that. But last time, Eric, gold and silver went up because of the fear of a tariff. It was just the COMEX futures that went up, while the spot price didn't do anything. But now the spot price is up like $100 since the international price is up $100 since last Friday. So what's going on here?
So I think you nailed it, Mario. If this is only like let's say a tariff situation like last time, but that was a little bit over a month ago when there was that confusion that the US may actually tariff gold and silver. What you see is you would see what happened last time, which is the futures price go up a lot and the spot price just kind of linger, at the same level. I mean, back then I explained it in such a way that basically says potentially it might be because they couldn't get enough physical gold and silver at the LBMA. Therefore, the prices over there is slightly lower just because people don't trust those contracts. But like you said, this time the prices at the LBMA is also going higher. So, you can interpret it in such a way that basically points to the fact that potentially what may actually be happening right now is that, yes, there's a lot of demand for physical gold and silver at the COMEX. And yes, there are doubts that you might not get your physical gold and silver at the LBMA on a timely basis, but because the pressure right now is so great to get your hands on physical gold and silver, and beggars are not choosers, it doesn't matter anymore. People are putting the bid at the local London, which is the spot market at the LBMA for physical gold and silver. Therefore, the even the spot price at the LBMA is going up.
That's right. And I've heard from several dealers and people in the UK and other places that they're having a tough time source physical silver. And I saw as well a post on X by, is it Bob Coleman? He said that they're having problems with their short calls, the bullion banks in silver, and that silver's gone up so quickly they're having trouble covering it. And I replied, well, I thought the bullion banks did everything. They were hedged on everything. So it just goes to show that the bullion banks, yeah, they're quite. I mean, this idea that they're always hedged is BS, in my opinion. When the market starts taking off or moving very quickly, they don't seem to be hedged anymore.
Well, my take on the situation on that front is this. Like I said just um, earlier in the program, I believe that the physical market at the COMEX and the LBMA is tight. I mean, some experts may say that, well, Eric, the COMEX cover ratio for physical gold and silver is almost 1 to 1, right? That's the COMEX vaulted physical gold and silver compared to the total number of open interests that is out there, like the total number of outstanding contracts of gold and silver at the COMEX. So theoretically, that's like backed 1 to 1. But wait a minute,
Yeah, they're saying
wait a
it's a
minute.
cash market then,
Yeah,
right? Yeah.
yeah, that's what they're saying. But Mario, wait a minute. How do we know how much of that physical gold and silver at the COMEX votes? How do we know how much of that is already spoken for? We don't know. Nobody knows.
Yeah, and
I mean, it can.
the eligible as well. Is that added onto it? Because eligible doesn't really mean it's on the COMEX. It means it's in another vault and it's eligible to be registered on the COMEX too, right?
Well, eligible and registered physically basically the same votes most of the time. So they just like, label it differently, as I understand, right? But it's the same physical vote of certified COMEX vote, essentially. And eligible all it means is that is a authorized participant who is storing COMEX compliant physical gold and silver. So that's the size and weight that is compliant to COMEX specifications. At least COMEX authorized vaults. That's all that means. Okay. And then register. All that means is that that physical gold and silver at the eligible vault is issued a warrant.
Oh, I see.
Okay.
I see.
Okay. So that's once you get the warrant, that physical gold and silver is designated as registered.
And
And
you
all
can
that means is
also,
that,
sorry,
yes,
and then you can withdraw it from the vault as well. That's the next step, right? And
correct.
we don't know how much withdrawal there has been, right?
Actually, we know it's around Bob the Bullion guy, who is a follower of mine. He did some calculations, and also PM Buck. Okay, these two gentlemen who follow me, and I follow them as well on X. It's approximately, I think, like 100 million troy ounces of, like, this is silver, right? Gold, I haven't looked into it, but it's probably in a similar, percentage basis. So it's around, you know, for this year, it's approximately, I believe, 1/3 of the total that came in. Okay, that has been 1/3 or 1/4. Okay, that of the physical metal that came in that's been withdrawn. But that's not my point here. Okay, so we know the physical metals withdrawn numbers. That's fine. It's high, which means that, like, whatever is coming in, it's not just all sitting at the convex vault. A lot of it is being withdrawn, okay, which adds additional meaning to the convex vault numbers, which is essentially at historical highs, okay? So think about this. The convex vault numbers are at historical high for their physical gold and silver, and yet approximately um, 1/3 or 1/4 of that has been withdrawn, okay, physically taken away from the COMEX vaults, right? Which means essentially what you see on the at the COMEX right now is not what they imported in total. They imported more than that. Whatever you see plus the 1/3 or 1/4 that's been withdrawn. So that's number one. Number two is that you mentioned the metal that is sitting at the COMEX register vault with the warrants. Well, guess what, Mario? The owner of that physical gold and silver can decide not to have that physical metal recirculated back into the COMEX system. Okay, so again, looping back to what the other experts are saying, they are saying, well, all those contracts at the COMEX are backed by physical metal. That's not necessarily true, right? Because if the owners of this eligible and registered vault physical metals decide to just sit on it, okay, use the COMEX vaults as a secure storage location for their physical metal, and they're unwilling to have that metal recirculate back into the COMEX system, then you see how the COMEX open interest or contracts are not actually backed one to one in that scenario. You see what I'm saying, right? That's why, my logic goes like this, okay? The all this open interest at the COMEX needs the LBMA, physical metals, to back up a big portion of it, which is essentially what we've been talking about with the EFP trading pairs, the exchange for physical, right? Like remember in our past interviews, I explained how when the bullion banks, when they slam, when they buy a lot of shorts at the concentrated shorts at the COMEX, they are buying an equivalent amount of longs at the LBMA, right?
Yeah, I remember
So
that. Yeah.
exactly. So I think that's probably the the area that we need to focus on, which is the LBMA. And ironically, that's what Robert Gottlieb mentioned, right? He's saying that the dislocation, now this is his theory, is that the players at the LBMA are unwilling to send the metal over to the COMEX because of the potential tariffs. That's what he said.
Yeah, that's right. And
That's it.
yeah, because those tariffs, Donald Trump came out and said that they wouldn't apply to gold, to those bars, uh, and then that he would issue an executive order. But I think Ronan Manley, about a week ago, he noted that no executive order had been issued. But and this is what Robert Gottlieb is saying, that the bullion banks are worried that if they send the gold bars from London.
So I think, in my opinion, the tariff situation is a moot point because we've been back and forth through all this for what, 6 months, right? Yes, tariff, no tariff, yes, tariff, no tariff. For anybody to convince me that after 6 months, they're still lingering on that issue. I think the primary reason why gold and silver are breaking out of their consolidation ranges for the last 6 months is because all of a sudden, the Indian central bank came out and said that they're reducing their US Treasury holdings and they are increasing their physical gold holdings. So I think that is the big shocker this week when President Modi of India, or sorry, Prime Minister, he's the Prime Minister of India, visited President Xi and met up with Putin in Beijing. So I think that's probably the primary reason. And on top of that, if you pull up that chart that I grabbed, that shows the global holdings of U.S. Treasuries versus gold, Mario.
I've got that, and yeah, I have spoken about this as well, and it's interesting because Mohammed El Arian, he's very mainstream, and he noticed this chart from Tavi Costa, right?
That's correct. So it's important because for the last 30 years, as Mohammed had pointed out, the primary global reserve asset for central banks around the world has been U.S. Treasuries. And you see how U.S. Treasuries started to sink in the last couple years in terms of like global central bank holdings, and physical gold shot up, and now physical gold is back, exceeding U.S. Treasuries as global central banks, primary number one um, reserve holding. So I think this fact, accompanied with the fact that India is now switching gears and looking at physical gold as their primary um, reserve asset going forward. I think that pushed, like I said, I think that pushed gold and silver um, beyond the trading range that they were in the last 6 months.
Yeah, and the significance of Prime Minister Modi meeting President Xi is quite immense because I don't think Modi had been at that SCO summit for 7 years because there is like a kind of like yeah, the relationship isn't great because of land dispute between the two countries. So I think Donald Trump has been able to actually unify those two countries a little bit more. I think that doesn't help either. And I guess you wanted to talk also about government bonds, right? Because I've been speaking about that as well, and we're seeing that they're starting to break out the government bond yields, and that's not a good thing because all the banks and big financial institutions they have loads of that stuff on their balance sheets.
So yeah, I mean, Mario, this is something that kind of popped out on Monday, right? Like France first came out and said like they have some major issues with their official situation. And then on Tuesday, like you said, a lot of these European sovereign bonds just kind of broke down. What I mean is, like you said, the yield shot up, which means their market values just dropped like a rock, right? And even the U.S. Treasuries, the long duration ones, like 10 years and above, have the same issue. I mean, CNBC came out with an article saying that, but they blame. Funny enough, they blame like tariff refund for that. I think like Donald Trump might lose a court case or something, and he might need to refund some of the tariffs to to the people that pay the tariffs, right? Anyway, the bottom line is it just seems like all these Western sovereign bonds are imploding. And this reminds me of what happened. Yeah, so Robin Brooks, he nice enough to put all the charts together of all the different European countries sovereign bonds, and as you can see, the yields are just shooting up for all of them. Um, so
Yeah,
anyway,
Eric,
like
sorry to
yeah, fine.
interrupt you. So it doesn't make sense what CNBC said or whoever was there saying it that the treasury yields went up because of problems with tariff refunds. If that were true, the other government bond yields wouldn't be going up either. I mean, they seem to be in denial about the fact that we have a sovereign bond problem, not just yeah, everywhere.
I mean, just look at the chart that Mohammed, cited, right? From was it Tavi of Crescent? I mean, look at that. It answers your question right there, right? It shows you that essentially what's happening is sovereigns and big players, they're dumping US treasuries and all these garbage European sovereign bonds for what? For physical gold. I mean, isn't that like a more logical answer to some, like what CNBC is saying because of tariffs?
I agree,
I mean,
and
yeah,
it's a
sorry.
bit like Robert Gottlieb as well, still trying to use the tariffs narrative for the price of gold. They don't seem to put two and two together, I think, because they don't seem to understand that gold is really important for the bond market. The canary in the coal mine warning people.
Yeah, so I think in an age where trust is being lost, and I'm going to, just tell your audience another piece of news that they may or may not find shocking. The EU, European Union, is considering confiscation of the Russian assets that they froze. Okay, so if that's the case, wouldn't that accelerate the loss of trust on Western sovereign bonds? Because let's say I'm like a Russia, like, I'm a China or I'm in India. That is a country that the West may or may not like, right? Or like, neutral on. And I bought a whole bunch of Western sovereign bonds. And I do something that the West doesn't like what Russia did. Just anything. I defend my own borders. I, sell some weapons to a country that the US and the European Union don't like. What are they going to do to me? They're going to do the same thing they did to Russia. They're going to freeze the sovereign bonds that I bought, right? Like, if I bought uh, the UK gilt or the US Treasury, they're going to freeze that. It's the easiest thing to do.
Yeah,
So yeah. So I think that has a lot more to do with you know, these these sovereign bonds being dumped and gold being picked up because gold, like we all know, is borderless, is has intrinsic value, right? It doesn't matter you know if someone tries to, let's say, sanction your gold, gold is gold, right? You can just resmelt it into something else. So I think that is the big picture. I think basically, I just tweeted, I guess, 5 minutes ago. I said the tyrannical age, the tyranny of the US dollar milkshake is coming to an end.
yeah.
It's coming to an end. Like we are entering into a multipolar world where physical gold is going to be the primary tier one reserve asset, especially for the global south countries.
I agree 100%. And if you're wondering here, the viewers, about this shirt, yeah, get stacked, gold and silver at Monaco 64. If you like this shirt, it's like a golf shirt. It's in the merchandise store. There's a link below in the description. And talking about gold, Eric, do you want to move over to the miners and what you're seeing there?
Absolutely. So Mario, if you look at the I have a chart that I borrowed from Crescent on the,
I've got it here. This one here.
let's see.
Is that it?
Yeah, this is the one. Correct. As a percentage of global equities. So we sunk to what? To 1%. All the way from 11% from 1970. So miners are really underinvested. I mean, we're just in the beginning, I believe, of miners coming back to relevance. So, let's not take 11% as our final goal. Let's just take, I don't know, 6%. Take the medium, right? The average, 6%. That's six times of capital rushing into the mining sector versus what we have today.
Yeah, that's huge. And the other thing as well, Eric, you look at this chart. This is the lowest it's been in over 120 years.
Correct. Um, Another thing that I keep telling people, not to do is the miners right now are relatively cheap. A lot of them are trading below their net asset value, which is, you add up all the equipment, the value of the land, the value of the physical gold and silver, etc. Right? You see, Garrett Gongan is really nice guy, really brilliant. He put together a chart showing you the NAV and the share price. Okay, do you see that?
Yeah,
Do you see how the share price discount is so much larger than the NAV discount?
yeah,
Do you see that? That means like the share price is not reflective of the true value of these miners by a large margin. Okay. In some cases, you are if you're paying for these shares, as long as they don't dilute, by the way, okay? If they don't dilute, your equity and you buy it, you are getting, you're getting basically a large part of the NAV for free, essentially.
yeah, yeah.
Okay? So that's what that is.
Okay, and what
So
we got here?
and my final chart I got for your audience is a chart of gold from 2009 to 2012. Do you see that,
Let's have a look.
Aaron?
Um, I think I need to get that one. Sorry.
It's the gold one, and I got like
It's
two
not this. It's
arrows.
not this one here. There's one from this in the 70s. It's not that one, is it? So
Well, you can pull up that. Let's pull up that one. I can talk about that one.
let me
Sure.
just get the. Oh, I think I've got it here. Is it from Luke Roman, the chart?
No, let's do the 70s one. You have the
Okay.
70s one with the
Yeah.
Nifty
And
50, right?
I've got the other one too later. So
Okay.
let's do
Okay.
the 70s one first then. Sorry about that. There you go.
It's okay. So this is a really I put together these two charts and it's very telling. It's the gold chart from 1973 to December 1974. Well, it basically spans the entire 1970s, right? But like I bracketed the period between 1973 to December 1974 in red, okay? And then on the left-hand side, I have a chart of the Nifty 50. That's like basically the um the Max 7 of the day. Okay, like the Apple, Facebook, and Nvidia, Amazon of the 1970s. Okay, and you see how the Nifty 50 peaked in 1973. Am I correct? Am I looking at that?
Yeah, that's
Because
right.
it's really small.
1970.
1973,
Yeah, that's right.
1973, and then it just kind of like went sideways and then sunk lower over the next 2 years, right? But during that same period, gold went up, okay, in price. So my comment is that if the US is compelled to keep liquidity up in the next 2 years or the next year, right? Because I don't know when gold is going to peak, right? But let's say the US managed to keep liquidity up for the next year or two. I believe that every time when the Max 7 corrects, yes, gold will correct. And the miners may or may not correct, by the way. Okay. But as long as liquidity is up, when the Max 7 corrects and gold corrects, when the Max 7 rebounds, okay, to a lower high, let's say they don't make new highs, they make lower highs, like the Nifty 50 in the 70s, gold will make new highs.
Yeah,
So that's what that chart tells you, right? The Nifty
yeah,
50 went down, but it wasn't a straight path down. It rebounded at lower highs, okay, on its way down. But every time when the Nifty 50 rebounded, gold also not rebounded. Gold made a new high, okay? And the miners made a new high. So that may be the roadmap ahead.
yeah. That's I
That's my
guess what
point
you're
for that.
trying to tell people is that a lot
Yes.
of people are concerned that If the Nasdaq or S&P enter a bear market like the Nifty 50 did there, that the miners would and gold would do the same. And you proving to us that in the 70s that didn't happen. Um, so I agree with you there. I've got the chart, the other chart, I think now that you wanted to show me. I think it's this one here. Is it?
Yes, so this one is like my personal experience, right? A lot of people, because of all the experience they had with miners, they're really scared. And any kind of correction, they sell all the miners because they think it's game over, right? So what you don't want to do is the next time when the miners make a intermediate high, you just dump everything. And then you stay out of it while the miners keep going up. And then when it does the FOMO peak at the end, I don't know, in 12 months or 24 months, you can't help yourself and you get back in. That's actually, by the way, that's exactly what happened between 2020 and 2021. A lot of people did that. They sold, after April of 2020, after the miners recovered, because if you remember, Mario, the miners were decimated in March of 2020 when that liquidity US dollar liquidity squeeze happened. So when those miners rebounded in April, May, a lot of people sold. And then they were very skeptical of that climb for the next 6, 8 months. And then a lot of people jumped back in 2021, and that's how they got burned. Okay, so my advice is, if you own some quality names and their market caps are reasonable, and there are a lot of ounces of gold and silver in the ground, just hold on to them. Don't jump in and out too much.
I see. I see. Yeah.
That's it.
It's usually amateur or retail investors and even professional investors, they tend to take profit a lot quicker than they take their losses. That's human nature, isn't it?
Yeah, I think so, Mario.
Yeah. So what do you think? What do you think could point maybe to not, to a major top where people should maybe take some profit?
I think what we got to do is we got to watch the global liquidity situation. So if global liquidity starts to dry up, then we really have to be careful of a potential, I would say like a longer term, like a midterm intermediate peak of gold and silver prices. But having said that, I think we are very far away from that. I
Yeah.
mean, silver is at 40, right? The historical peak of silver is at 50. So I think this time, in my humble opinion, I think silver is going to break 50 and possibly test 60, $70, etc.
Yeah, maybe then you might want to take a little bit of profit from your silver miners, depending how they do. I guess if they're up to 70. But I guess would you should we be watching like for liquidity like M2 and stuff like that from the central banks and monetary policy as well?
Yes, I think that should be sufficient. USM2, the China liquidity situation, see what the PBOC does, right?
Yeah.
That kind of stuff. Yeah.
Great, great, Eric. Thank you so much for coming on. And yeah, we live in interesting times, as the saying goes.
Yes. Thank you, Mario. It was a pleasure.
Great. I'll talk to you later.
Thank you.